Good morning. Last lecture was too chaotic, even by my standards, so we'll try to talk about those topics again and do it better. We were talking about the determination of exchange rates. Thank you. And we said the exchange rates, just like any price that are market determined, are determined by the supply of currency and the demand for currency. Here we have the price of lira. This is the price of lira. And therefore we're, okay, so what has happened to the lira when we're moving up here? Is the lira appreciating or depreciating? Very good. Wow. Impressive for a Monday morning. So this is the opposite of the way we're used to thinking about exchange rates, right? When this exchange rate increases, we're saying the lira is appreciating. Right? Good. And we were asking, okay, so what determines where the supply of liras and the demand for liras will be? And we said one should think of this in different ways. There are several forces at play. One of these is the purchasing power parity, affectionately known as the PPP. The purchasing power parity is the international law of one price. It says the same good in different currencies should cost the same. So the idea is that the price level in Turkey should be the price level in whatever foreign country times the exchange rate between Turkey and the whatever foreign country. How are we defining this exchange rate? Is this liras per foreign currency or foreign currency per lira? Cool, good, yes. So this is liras for foreign currency. This is the way we're used to thinking about exchange rates. When you read your book, you're going to notice that that's not how your book thinks of the exchange rate, which is not going to make your life easy. Now, this says, or this makes us think that we can also define a real exchange rate. This is the nominal exchange rate. The real exchange rate is going to be the exchange rate times the foreign price divided by the domestic price. The real exchange rate is something really simple. It says, let's measure the cost of the foreign goods in this country. Okay? So if I'm buying in the foreign country, converting the value to the domestic currency and selling in the domestic currency, what is the price? Right? If this is correct, what should this be? 1. Okay? If the purchasing power parity holds, then the real exchange rate has to be 1. The purchasing power parity says the same good in different currencies has the same value. Okay? Well, this is exactly that value. What is the relative value of the same good in different currencies? It has to be 1. Okay? It's never 1. When you're doing this with baskets of goods, I could think of this as the price of apple in Turkey, the price of apple in China, and the Turkish lira and the Chinese yuan exchange rate. Okay? I could also think of this as the Turkish consumption basket, the price of that basket, the price of that same basket, not the Chinese consumption basket, right? It has to be the same basket. The price of the Turkish consumption basket in China times the exchange rate That should also be the same. It isn't, right? So we talked about some reason why it wouldn't be the case. The fact that there are different taxes would be one. The fact that there are transportation costs would be another one. The fact that there are non-tradable goods will be a huge one, right? But even when you take everything into account, this sadly doesn't seem to hold as strongly as one would think it would. This is a very weak force, but it's a very persistent force. One way of thinking of the purchasing power parity is in terms of levels, like this. The other one says, well, different countries have different, for whatever reason, have different price levels. There is a level difference here. But at least in changes, it should work correctly. Okay. So the weak form says, the percentage change in the domestic prices, this is Turkish inflation, should be the percentage change in the foreign inflation plus the percentage depreciation of the currency. This is something we care about more than this, because we know that this just doesn't hold, right? And we have some reasons to say, well, we kind of understand why it doesn't hold very strongly, all right? But at least we should be able to say, you know, starting from some level, if prices in Turkey are increasing very quickly and prices in Japan isn't increasing, it must be the case that the Turkish lira is going to lose value against the Japanese yen. Does this make sense? Sure. Well, that's exactly what this says, right? When we're saying there's inflation in Turkey, we're saying, well, the Turkish lira is losing value against goods and services. Right? The Japanese yen isn't losing value against goods and services. So the Turkish lira should lose value against Japanese yen. That's what this says. Very good. We said this is a very weak force. And the fear is we're going to see this not holding, not holding, not holding, and then suddenly adjusting. Right? That's when you see the exchange rate jumping around. You're Turkish, you've seen this many times. So from, say, 1999 to the end of 2000, you see that, you know, inflation in our country is still very strong. We are a high inflation country, but somehow we are oppressing the exchange rate. We're going to talk about how you do that. The exchange rate is not allowed to depreciate. What is happening to the real exchange rate? So don't say increase, decrease. That doesn't mean anything to me. Is it appreciating or depreciating? The exchange rate, the real exchange rate appreciates like crazy. Okay? What's happening here? You're not letting this change much. There isn't much inflation in the foreign currencies, foreign countries. A lot of inflation in your country. P is going up. Okay? The real exchange rate is appreciating. What is happening? The Turkish goods and services are becoming expensive compared to the same stuff in the foreign countries. What happens to your net exports? It decreases a lot, right? This says you shouldn't expect that to continue forever. What happened? Did it adjust? Did we see a movement towards this? Did the exchange rate depreciate like crazy in 2001? Yes. That's what this says. Okay? We saw P going up a lot, foreign P not changing, the exchange rate not changing. Well, it says something has to give. That just doesn't work that way. All right? Well, what happened? What do you have to see? Either we're going to have deflation in Turkey. I don't think so. Okay? And not a good thing, by the way. Or Turkish inflation won't change, but the rest of the world is going to have huge inflation. Not going to happen. Or the Turkish lira is going to lose value. Yeah. And it did. Now, if you see this many times, you begin to think that, this is like God's word. It always holds. It doesn't. From 2002 to today, right, the cumulative inflation in Turkey is a lot. The cumulative inflation in England is little. The Turkish lira actually gained value against the pound. So this looks nothing like it's holding. What should we think? Should we fear that, soon we're going to see an episode like 2001 again? This is going to jump up. Now you understand why people get antsy when they see that the Turkish lira isn't depreciating, right? Because, okay, we have had a huge, very successful disinflation, but we're still a relatively high inflation country, right? Our inflation rate is now around 10%. When you look at our trading partners, their inflation rates are around 2%, 3%. If that's the case, you expect the Turkish lira to lose value, but it hasn't. What should we think? The problem here is, if you believe that this doesn't always hold, so that there are adjustments every now and then, when you see changes, it's easy to say the Turkish lira has appreciated in real terms, right? It's a fact that from 2002 to 2010, the lira has had a non-trivial real appreciation. The lira has gained value in real terms. Okay. Now, should we think that, well, then something is wrong? At some point, it will have to lose value in real terms. That's how most of the people in our country, and most of the, actually, when you read the newspapers and stuff, you see that this is implied. People believe that this is going to happen, it has to happen, right? That's not correct. The reason why it's not correct is you don't know whether you started from the correct level. In 2001, we looked at the jump in the exchange rate and said, yes, the exchange rate was wrong from the purchasing power parity perspective. It corrected. Okay? From 2002 to 2010, we see a real appreciation in the lira. We're not used to that. Right? So we're thinking that this must be something wrong. This must be something that will eventually be corrected. Could it be that, so what we're saying is the exchange rate in 2002 held correctly. Now that there's a discrepancy, we moved away from the correct exchange rate, and we have to go back to it, right? Well, maybe it's not the case. Maybe what was wrong was the exchange rate in 2002, and we have corrected that over time. Can we know this? That's the point, right? We just cannot. To be able to say an observed real appreciation of the appreciation or the depreciation of the currency is something that needs a correction, requires you to have some faith in the fact that the exchange rate at your initial observation point was the correct exchange rate. Right? That's a very hard argument to make. So what I want you to take out of this is that this is a very useful way of thinking. This is a very strong mechanism. But you shouldn't think of these as giving you forecasts of exchange rates if you think that deviations are possible. We know that deviations happen. We know that the real exchange rate isn't 1, and the real exchange rate itself appreciates and depreciates. So there are deviations. And given that there are deviations, just by looking at changes, you cannot make a statement about whether the level is correct or not. Right? All we've seen is the Turkish lira has gained value. This could be because something is wrong and the Turkish lira is gaining value, say, by mistake. Okay? And it will have to lose value. Or it could be that it had lost too much value earlier, and now it's moving to its correct value. All right? This is one. Now let's think of the implications of the purchasing power parity for exchange rate determination. What is the mechanism? Let's say the lira appreciated like crazy. Let's say the problem here is this isn't holding and the lira is too valuable, right? What is happening? What happens to the demand for liras and the supply of liras? Let's think of this. Okay, so what we want to think of is who demands this currency and why? So why do foreigners ever want to sell their currency and buy our currency? Or why do we ever want to sell our currency and buy foreigners' currency? So? Okay. So you can purchase things. That's called, we have terminology for that. We call it trade. Trade is a very important part of this. Why do we want euros? Well, because we're going to buy French wine, and French wine is sold in euros. Why do the French want liras? Because they want hazelnuts, and hazelnuts are sold in liras. Now, let's say suddenly the French want a lot more hazelnuts. What happens to the value of the lira? Think of the steps, right? You're giving the right answer, but I want you to give the right answer for the right reason. If they want more hazelnuts, do they have to pay more for that? Yes. In which currency? Right? They're buying our goods, they have to pay in our currency. So what do they have to do? They have to sell their euros, buy liras, and with those liras, buy hazelnuts. If people are selling their euros and buying liras, what happens to the lira? It appreciates. Cool. Now let's relate this to the purchasing power parity. Let's say the purchasing power parity does not hold, and the lira is way too appreciated, right? What is happening to trade if the lira is appreciated? Net exports decrease. What does that mean? Are we buying more foreign goods, or are foreigners buying less of our goods? It means both. Your currency is too valuable. Are you able to buy? So do the foreigner stuff look cheap to you? Yes. Are you buying more of that? Yes. Your currency is too valuable. Is your stuff cheap for the foreigners? No. So they are buying less of that. So if we are buying a lot of foreign goods, are we trying to buy a lot of foreign currency? Are we trying to sell a lot of liras? Yes. If the foreigners aren't buying our goods, do they want a lot of our currency? What will happen to the value of our currency? It will depreciate. That's why we call that a force, right? If the real exchange rate is appreciated, if we have deviations from the purchasing power parity, right, we're going to have a trade imbalance. And that trade imbalance is going to mean that there's going to be a movement towards the PPP holding. We started from the assertion that the lira is appreciated. It's too valuable. And now you told me that if it's too valuable, it's going to become less valuable. It's going to depreciate. Okay? If the lira is too valuable, then you're going to have a trade deficit. If you have a trade deficit, that means you're buying too much foreign goods and you're selling too little domestic goods. That means you want a lot of foreign currency, but the foreigners don't want your currency. That means your currency is going to depreciate, right? Cool. Do we have a trade deficit? Yes. See, if people think that your country has the wrong level of the exchange rate, the lira is too appreciated, and they also see this huge trade deficit, what do they think? Well, they think they're right, okay? This link between exchange rates and trade is an extremely important one. It's extremely important for thinking about why these exchange rates why they matter, but they're even more important to think about policy implications. You should now be understanding why the exporters in this country continuously want the central bank to depreciate our currency. Is this good for the exporters? This is a trick question. If you are a really successful exporter who is able to sell all of her production anyway, do you want the currency to depreciate? I'll let you think about this, okay? Does it matter whether you're a successful exporter or an unsuccessful exporter?
If you're successful and you can sell your product anyway, you don't want it to depreciate.
Okay. Why not? Yeah, okay, you sell it anyway, but what happens? But that's the question. Do you earn more? You're selling your goods anyway, right? And then the lira depreciates. Does it matter for you? No. Don't jump. Just think about it a little bit, okay? We'll talk about it on Wednesday. Now, in our country, it's usually the less productive exporters who usually push for this. Why is that? Let's say you are relatively less productive. What does it mean about your prices? Are your prices cheap or expensive? Are your prices low or high? Your prices are high. Your prices are high in which currency? In liras or in dollars? In liras. We do production in liras. We do accounting in liras, right? You're a unproductive producer. You're finding it difficult to sell because the productive guys have lower marginal costs. They are able to sell at lower prices. If you want to compete, what do you have to do? You have to increase your productivity. That's the general correct answer. That's not an easy thing to do. Is there an alternative? Yep, exactly. You could also ask the central bank to depreciate the currency. If the currency depreciates, you're still as unproductive in Turkish liras, but you seem to be more productive in dollars and euros. Okay? Your goods are now suddenly cheaper for the foreigners. Can you now sell to foreign countries? Yes. Cool. So what happened to these people when the lira appreciated over the last 8 years or so? Productivity in our country went through the roof. Productivity in our country increased like crazy. One of the reasons is, nobody talks about this, okay? This is a taboo, but one of the reasons is the appreciation of the currency. The appreciation not only gives a strong incentive to exporters to be more productive, it forces them to be more productive to survive, right? Okay, so, are we clear about what the purchasing power parity means about the exchange rates? Slowly, very slowly, it forces the exchange rate to move in the direction to close the trade gap. If you have a large trade surplus, that means you're selling too much of your goods and buying too little, then your currency will appreciate. If you have a trade deficit, that means you're selling too little and buying too much, then your currency will depreciate. All right? Good. That's not the only force that's in play. There's also a much shorter term idea. Uncovered interest parity. The purchasing power parity says different goods in different currencies should cost the same. The uncovered interest parity says your savings in different currencies should bring the same return. Here's the question. Can you buy a dollar-denominated bond today? Yes. Can you buy a Turkish bond today? Turkish lira bond? Yes. If you're able to buy both of these, can one have a significantly higher return than the other one? This is the trick question. They can have different returns in different currencies, obviously. But would you buy one of these if you thought that once converted into Turkish liras, the dollar bond has a much higher return? So I'm offering you two items. One of them is a Turkish bond that returns, let's say, 8%. The other one is a dollar bond that returns 2%. One is in liras, one is in dollars. Okay? Are people buying and selling both of these? Yes. If one is too cheap, it has too high a return, would people be buying both of them? Or would everyone buy the cheap one? You see that if both of these are in play, okay, there has to be some relationship between their returns, between their expected returns. Thinking of the Turkish lira one is very easy. Right? You give up your Turkish liras today, you get them back a year later, but you're rewarded with an 8% interest. Good. Thinking of the dollar one is a bit more complicated for us. Why? Because we first have to convert our liras into dollars, buy the dollar bond. A year later, we get a bunch of dollars, and then we have to convert it back into liras. It's that conversion back into liras. The exchange rate isn't the same. That's the point, right? But given your expectations about the exchange rate, let's say we knew that the exchange rate would be the same. We are like dead sure that the exchange rate is not going to change. What does it mean about the lira interest rates and the dollar interest rates? They should be the same. Okay? What if we knew that the lira is going to lose 2% of its value against the dollar? So now we are dead sure that the lira is going to depreciate 2% within a year. What should be the difference between the dollar exchange rate and the lira exchange rate? 2%. Which one should be higher? Liras. Think of the steps. You sell your liras today. Okay? Now you have dollars. Let's say the dollar gives you no interest. Okay? The dollar bond gives you no interest. You just convert back into liras a year from now. Do you have the same amount of liras? Do you have more liras or less liras? The lira lost value. You have more liras. You had dollars. Right? You have dollars. You're now buying liras. If the lira has lost value, you're getting more liras. Okay? So the lira interest has to compensate you for that. The lira interest has to be higher. The general idea here is that the interest rate is the foreign interest plus the percentage depreciation of your currency. Okay? it's important that you understand the steps. If you think that given the Turkish interest rate and the foreign interest rate, say the US interest rate, okay? What happens to the exchange rate? If the Turkish interest rate is too high, let's write this. This is going to be easier for you. Plus expected depreciation. When we see that Turkey has to offer a lot higher return than foreign countries, we understand two things. One is that either our currency is expected to depreciate, or there's a third term here, plus risk premium. The risk premium is, there's no polite way of saying this, the world doesn't trust Turkey as much as it trusts England. Okay? So all else equal, selling a Turkish bond isn't as easy as selling an English bond. How do we know this? Well, Turkey borrows in euros as well. The Turkish government borrows in euros. The German government also borrows in euros. These are both euro instruments of the same maturity. Should they have the same price? Well, they should. Do you think they do have the same price? In fact, if the Turkish, just imagine this. This is the world investors. You're faced by buying either a Turkish bond denominated in euros or a German bond denominated in euros. Which one would you prefer? Many of you immediately said German. If your answer is German, you're telling me that a German bond and a Turkish bond in the same currency of the same maturity are not perfect substitutes. These are different things. Why are they different? In one of them, the German government promises you to pay you back. In the other one, the Turkish government promises to pay you back. And what you're telling me is the Turkish government's promise isn't as promising as the German government's. That's going to lead to interest rate differentials. Now, it's one thing to talk about the expected depreciation. It's another thing to talk about the appreciation of the currency or the depreciation of the currency today. Here's the idea. Let's say we were at some equilibrium point. So the expected appreciation or expected depreciation is correctly priced. The risk premium is correctly priced. Right? So people are buying Turkish bonds and German bonds and Chinese bonds and everything. And then suddenly, our central bank comes out and says, we're increasing interest rates. The Turkish interest rates increase. What happens to the exchange rate? Think of the steps. You're an investor. You could buy Turkish bonds or French bonds. In fact, you used to buy Turkish bonds and French bonds. But suddenly, the Turkish stuff began to offer you a higher return. Do you still want to hold the same combination of Turkish bonds and French bonds? No. Which one do you want more? Turkish ones. What do you need for that? Turkish liras. Very good. What will happen to the currency? The currency will appreciate. When you increase the interest rates, in the short run, the what is important here is that the interest rates are increasing for their own reason, okay? They are not increasing because of expected depreciation or things like this, right? The central bank comes up and says, the Turkish economy is doing too well, there's too high inflation, demand is increasing too fast, so we're going to increase the interest rates to slow this down. That's what the central bank does. To combat inflation, the central bank increases the interest rates. When they increase the interest rates, what happens to the Turkish lira? It appreciates, right? So a second way of thinking of exchange rate appears to be cyclical. Cyclical considerations. You can think of these as central bank's policy. You could also think of these as general considerations about where would I like to invest. Think of two countries. You have your capital. You're going to either lend to these people to do investment, or you're going to go there and do investment yourself. One of these countries is doing just wonderful. It's great. It's high growth. Things are perfect. A cyclical upswing. Beautiful. The other one is in this protracted recession. In which country would you feel more like investing in? If the answer is the first one, then what you're saying is, if I think that a country is doing better, or if I think that a country will do better, I'm more likely to invest in that country. What do you need to invest in a country? Their currency. What happens to the country's currency then? Appreciates. Okay? So, if you get news that Turkey is going to do better somehow, okay? Usually, it's accompanied with an appreciation of the lira. We see these in small windows of time. So, for example, when you hear what happened to the exchange rate when it turned out that AKP was not going to be closed. Remember that? I'm fairly sure you do remember that, right? The governing party was, you're looking very puzzled. The governing party was being investigated. There was a chance that they were going to be closed down, right, for being anti-secular, blah, 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 okay? Now, is this a risk to the economy? Regardless of how you feel about the party and whatever, right? The fact that you can wake up one morning and learn that, there is no government is a huge risk to the economy, okay? So one afternoon, you learn that that risk is eliminated. The party is not going to be closed. What happened to the exchange rate? So we're talking about like the 2 minutes around that announcement. Okay, so don't use this increase, decrease terminology, okay? Did it appreciate or depreciate? Yes, the lira appreciated, right? Now, you see this very often. These are the good times to think of whether exchange rates move in the directions that we expect them to or not. When you look at months, years, a lot of things happen, okay? You don't know which way the causality goes. But right around the times of, for example, the central bank's announcements of interest rate decisions, okay? If the central bank comes out and says, you know what, you expected me not to change the interest rate, but I'm increasing it 2 percentage points. What should happen to the exchange rates? Should the lira appreciate or depreciate? The central bank says the interest rates are now higher than you thought they would be. The lira appreciates, okay? We see this in the data. When you look at only the days when the central bank comes out and announces monetary policy decisions, okay? And when you look at the surprise component of those decisions, there's a small There's a small link, but the link is there. When the central bank increases interest rates, the lira appreciates. Now, the relationship is tiny. Okay? It's so small. This is one of my studies. And also, Yusir Özcan, who is the TA for some of you, works on this. It turns out that there seems to be a relationship between the policy decisions, the interest rates, and the foreign value of lira, but that relationship is very small. Okay? You see this at times, you see this more strongly at times of, for our country, at times of fiscal policy announcements. When the government says things like, for a long time we talked about whether there would be an agreement with the IMF or not. Right? News that made people think that an agreement with the IMF is more likely made the lira appreciate or depreciate. Give it a thought. Okay? I'm asking you a theoretical question, but this is an instance where I know that the data supports the theory. What should it do? If you think that your country is about to have an agreement with the IMF, do you expect your currency to appreciate? Or if you think that your country is going to have an agreement with the IMF, will your currency appreciate or depreciate? Okay? Why appreciate? Very good. So this is one reason, right? This is the direct reason. Now let me ask you a different question. Let's say you're going to have an agreement with the IMF where the IMF will not give you any money. They're just going to monitor you. Okay? So you're going to agree with a plan with the IMF, and the IMF is just going to announce whether you're going to follow that plan or not. Okay? So now we're making it easier, and we're separating two effects. Will that make your currency appreciate or depreciate? Or no effect? Why also appreciate?
Because if there's an outside force, there are productivity and
something like that. The general thinking runs, why are you having an agreement with the IMF? Probably because you were doing something stupid, not sustainable. And now you're saying, well, we're no longer going to do that whatever stupid thing we used to do. Okay? So is your economy going to do better or worse? Better. If it's going to do better, what will happen to your exchange rate? There you go. Cool. So we have a fairly good understanding now of how exchange rates are determined. Right? You must understand that, in 2007, when it was time to elect a president, and just when the parliament was going to do it, the army said, you know what, we'd like to have a say in how the president is elected or who the president is going to be as well. You remember that this happened, right? You weren't this tall, right? You were this tall at that time. So you remember that just as it became clear that the AKP was going to choose whoever they wanted as the president, right, the army came out and put out a press release and said, you shouldn't be doing that, which isn't something normal countries have. Okay? If you're a Turkish investor or a foreign investor, are you happy that you're invested in this country? No. What happens to the Turkish lira? Sure. You see this in the next morning, right? I mean, politics and economics aren't two separate realms of the world. Now, let's take a 5-minute break and be back in seriously 5 minutes, okay?